There's propaganda machine through Bloomberg and other news channels to hate on China because China is seen as the enemy of the United States because it's so advanced now. How you'd run your own business is how you want to buy a business. There's no difference. If you want to get really great returns, diversifying across multiple assets is not a wise strategy to build wealth. The portfolio can swing 6 figures a day. And when you're first starting out, your portfolio swings very small because you've got a small amount of capital. The S&P 500, I think it's a wonderful way for lay people, 99.9% of people to invest. I'm Lloyd James Ross, 7-figure investor and entrepreneur, and I've helped thousands of business owners and professionals turn financial stress into success. If you're stuck in old money habits, overwhelmed by investing, or unsure where to start, this is for you. I'll give you the mindset and strategies to take control, grow your wealth, and achieve financial freedom. It's time to make your money work for you. Everyone says diversify, but what if the truth is you're just watering down your returns? Today I'm talking about de-worsification. Yes, you heard that right. When you diversify too much, you can diversify and underperform when it comes to your returns. And this is what happens when people own a lot of different assets. They own some gold, some crypto, some stocks, the property, private equity, art, Lego, They just got everything everywhere. They're just so spread thin that the actual returns, they might feel smoother, but they're a lot lower. And so Warren Buffett has been coined to say that he prefers a bumpy 16% a year than a smooth 12% a year. And so you have to understand if you're going to focus your investments, you'll get a better return, but it will be bumpy. It's quite volatile. So it's not for everybody, but in this particular episode, I'm going to dive into what it looks like to beat the market. And it's not an easy thing to do to beat the market, which means beating the performance of the S&P 500. But for the last 12 months, I have beat the market in our portfolio. It's not the first time, hopefully not the last, but I did that with a simple 3-stock portfolio. And what people might see there is a very focused investment strategy, but for me, it doesn't seem that way. And I'll dive deep into this episode and explain why. And if you've been listening to the show for quite a few years, you'll know that I almost went into indexing because it is a very sensible strategy. So this is definitely not an episode where I'm beating up the S&P 500. I think it's a wonderful, indexing is just a wonderful way for every, lay people, 99.9% of people to invest. And it's not me saying that. Warren Buffett and Charlie Munger at the Berkshire Hathaway meetings, more than half a dozen times, so many times they've said this. People have said, hey, what do you do with your money if you don't want to be an active investor and do it all yourself? And they've said on multiple occasions openly and publicly, hey, it's probably best just to buy some sort of broad-based index fund and continue to buy that and you'll do pretty well. So I'm not here to beat it up. I love indexing. I'm all for it. It's just that I love, and really it is my passion to actually deploy capital and actually actively invest in our own portfolio. And I do that with the intention to beat the market, meaning if our portfolio does not outperform the S&P 500 index, then what am I doing with my time? It's a waste of my time. I may as well just index, spend no time in it, and get a reasonable return, which is an intelligent thing to think about and do. And so I do think about this a lot. I actively invest. And for the last 12 months, but certainly year to date, our portfolio year to date is up about 30%, and the S&P 500 is about up 1.5%. So year to date, we're absolutely thrashing the S&P 500, but for the last 12 months, we have also outperformed it with a very concentrated portfolio. So just a bit of a caveat here, it's not financial advice. I don't want to dive into that. I'm going to touch on what some of the things I've looked at and do, but I don't want to give away anything because I don't want you to just go and copy me and do that. This is for education purposes only. It's not about hype or gambling. It's just a lesson about, hey, if you want to get really great returns, perhaps diversifying across multiple assets is not a wise strategy to build wealth. But without a doubt, to maintain your wealth, diversification is incredibly powerful and it's definitely to be done. But I'm talking to those who really have the intention to really go after it and grow their money, who want to pay attention to it and do the work, all right? And if that's you, you'll probably find this episode really interesting, all right? So if you want above average results, you got to stop selling for an average strategy. Charlie Munger used to say, if you don't have the emotional intelligence or the stomach for volatility to see your portfolio go up and down a lot, then you deserve the mediocre return you're going to get. And so this does require not IQ, it kind of requires a bit of EQ. It requires being able to manage your emotions and look for data and do your research and just actively understanding what you're owning. So for many years, I have actively deployed our cash in our portfolio, in our share portfolio, into individual companies. And some parts I've indexed very briefly, but I've actually avoided that for quite a long time because I have a bit of a knack for finding good quality companies that outperform the index. So I like to do it. It's a passion. It's not for everybody, but hopefully this episode gives you a bit of insight to what goes on in my head. So let's get into it. Number one, why just 3 stocks? Most people over diversify and end up with like 100 stocks, and that's not an ideal way to build a portfolio. Bill Ackman, who's one of the best investors of all time, says, a 10-stock portfolio would equip you with plenty of diversification. Think about it. If you own a coffee shop, right, and a house, you have 2 assets that you're diversified into. If you owned 10 different businesses, you're very diversified, right? So that's what stocks are. Stocks are just pieces of businesses. So if you own pieces of 10 individual stocks, you effectively own 10 different businesses. That's very diversified. And so people often say that a portfolio of 10 stocks or less is actually a very concentrated portfolio, but I actually think that a portfolio of 3 businesses is a concentrated portfolio. And it's not just me. Charlie Munger, who has outperformed, well, before he passed away, sadly, outperformed the S&P 500 by a long mile for many years before he joined Warren Buffett in Berkshire Hathaway, where they've beaten the market since 1965. He would often say that his personal wealth was in 3 stocks. He held Berkshire Hathaway, Costco, and up till when he passed away, it was probably Alibaba, right? So 3 core stocks. In fact, it was primarily Berkshire Hathaway and Costco, and then a private real estate portfolio, like I think 1 or 2 residential houses. And he would often say that if you had a business and a piece of real estate and some stock, you're pretty invested. So like, you don't have to go over the top. And I see this a lot with people with their portfolios. I've got 100 stocks. I'm like, whoa, like you're so diversified that returns are going to get hurt. But for me, 3 positions. In fact, our portfolio at the moment is 4 positions, and they're quite big bets. And so you have to have a lot of conviction and do a lot of research and do a lot of work to know what you own. And the way to approach it is when you buy a stock, you have to understand the business because you're buying a business. So you're really more of a business picker than a stock picker. All right. So you have to understand what the business does, how it makes money. Will it be, disrupted by AI? Will it be competed away by its competitors? Will it still be here in 20 years? Well, this is why I don't invest in high tech companies because it's difficult to see where they're going to be in 10 years, which is why I've not touched Tesla. It's just too hard to see where it'll be. And I think people can get caught up in the hype and the fun of tech, but look where a lot of the dot-com bubbles tech stocks went to. They went to zero because people were getting excited about the tech. It's not the tech, it's the business model, and it's the competitive advantage and durable competitive advantage that business has against its competitors that matters most. A great business can also become broke. So you have to be very careful about what you're doing. So we have a 4-stock portfolio at the minute, but the 3 stocks, even with the 4th one, it's outperforming the index. Okay. So it's been a fun year and you got to be very careful. So I'm under no qualms about what that looks like. But at the same time, the portfolio can swing. Like last night it can swing by 6 figures a day. And when you're first starting out, your portfolio swings very small because you've got a small amount of capital. But when it gets to the multiple millions, one day can swing. I remember during COVID, it swung 300,000 and it can swing big. And so you have to detach yourself from the volatility. What you got to focus on is the business doing well? And so many times I've seen wonderful annual reports and quarterly reports because public financial companies have to report quarterly their financials. And I mean, lately, one of our positions, they reported incredible growth, 24% growth, 14% earnings growth, lots of cash in the bank, no debt, growing. It was a wonderful report and the stock went down. In the short term, the stock market is a voting machine, meaning people are voting for it, like, oh, buy and sell, buy. But in the long term, it's a weighing machine, Warren Buffett would say. Just quickly, if you're ready to take control of your finances but feel stuck on where to start, I have a solution. My book, Money Buys Happiness, simplifies investing and wealth building with practical steps to help you achieve financial peace. Get your copy via the link in the show notes and let's get your money working for you. Now back to the episode. And a weighing machine means that over time, the stock price will follow the performance of the business. So as long as you're focused on the performance of the business, the stock price will look after itself. So you can't get carried away with what it'll do even quarter to quarter. Like even with your own business, like in our businesses, income goes up and down a lot. And people are expecting it to be nice and flat and smooth. It's not. We're in business, right? So stocks are it's never going to be smooth. As long as the fundamentals are improving. Is the business growing? Is it got good leadership? Has it got no debt? Like, these are all important. How you'd run your own business is how you want to buy a business. There's no difference, right? So if you've done your research and understand the business and you find 3 great businesses you want to invest in, like, they're your 3 best ideas. Charlie Munger will often say, why would you bother with a 4th idea if you're better off to put more into your best ideas. And he and Warren Buffett would often put over 100% of their net worth into one business. And that makes a lot of sense because you actually have, if you've got one business and no other assets, you've got your entire net worth in that business. So you're actually all in on there too. So I think it's pretty diversified to have a few stocks depending on what you choose, all right? So what are the stocks? Let me explain the 3-share portfolio that's outperforming the market. I'm not going to tell you the exact stocks because you're going to go and do it. I don't want you to do that. I'm just going to give you an example of what they are and why they've been selected and what we anticipate to happen over the next 10 and 20 years. The first one is China's largest internet retailer. The second one is China's online version of Costco. And the third one is Warren Buffett's $1 trillion company, okay? There's some little, that's kind of what they are. They're not random picks. I've been reading Berkshire Hathaway shareholder letters since 2011. And hopefully this year I get over to the Berkshire meeting, and I've studied Warren Buffett and I understand what I own in that business. That business actually owns 70 publicly held companies and probably around the same number of private companies. So we could say, ballpark figure, it owns between 120 and 140 different businesses in one. So in itself is like its own little mini index fund. So for that business or that stock to go to zero, all 140 or all 70 stocks it holds has to go to zero, and all 70 operating businesses also have to go to zero. Now, the odds of that happening are very, 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 very low. Does that mean that the business can't get in trouble? No. Right now, they've got a lot of cash, but it's a well-managed business. It's got a wonderful culture. And for however many years since 1965, it's just done so well. And so understanding these concepts of actually, what do I own? Oh, I own a lot of businesses in there, so it makes a bit of sense. Now, looking at the other part of the portfolio too, a very large portion of it is actually allocated to China. When some of my buddies talk to me about what they're investing in and stuff, and I talk to them about the large allocation we have in our portfolio to China, they all freak out. Like they go, what? China's so risky and because they're indoctrinated by the media to hate China. So what's happened in the United States is there's propaganda machine through Bloomberg and other news channels to hate on China because China is seen as the enemy of the United States because it's so advanced now. And what actually happened recently with TikTok, the TikTok ban, is a lot of TikTokers went to red note. And when that happened, the American public started to see China for what it was, a very well-developed economy. So if I look at that, it's growing at 4.5% GDP growth. It's got a lot of macro headwinds and stimulus coming. It's managed well. It's got good leadership and invested in its people. I mean, it's got some of the best businesses in the world. Some of these businesses are astounding and they're cheap and they've got cash on the balance sheet. You get more bang for your buck there. And Charlie Munger would often say, if you're going to fish where the fish are. So right now, the market's so high in all these places that one of the few places left of any value is China, which is why the portfolio is angled that way. All right. So looking for undervalued conglomerate companies that, in fact, one of them's got 6 businesses in one. So you can see here that, yes, it's a 3-stock portfolio, but all 3 positions own more than one business in the company. So it is a very diversified portfolio. It just looks like it's not. And that's the trick to it, all right? So why am I doing this now? Because, again, most of the markets in the world are actually really overvalued. And what I want to do with our capital is deploy it in areas where I'm getting more bang for my buck. And one of the few places at the minute to do that is China. And one of the best things to do too is to partner with Warren Buffett. And, you know, I find it very hard to buy real estate right now in other places. So it's a reason why we've positioned it that way, all right? So I've held diversified portfolios before. I've held very concentrated ones. I try and allocate the capital to areas where it's going to safely grow over time to beat the market, okay? And that just happens to be where it is now. If that ever changes, you change the portfolio, all right? So that's why sometimes you got to concentrate and double down on your best bets. Why put stuff in your second best position, right? It's not about gambling. It's about backing what you know. Know what you own, understand it, deploy it, and be patient. Diversification feels safe, but it can just water down your results, right? So the wealthy don't just scatter their bets, they place bold, informed ones with conviction. So if you've done your research, understand the business, and believe in the long-term upside, and back it, because average strategies get average results. I'll see you in the next episode. Thanks for listening to Money Grows on Trees. If you enjoyed the episode, leave a 5-star review on Apple Podcasts and Spotify, and subscribe to us on YouTube so you never miss an episode. And if you're serious about building wealth, make sure to check out the links in the show notes and follow me on all social media platforms at Lloyd James Ross for more. See you in the next episode.